Welcome back to our pre-budget special Ideas for India. Today we are discussing the most important idea for the Indian budget, whether the fiscal balance should be maintained at 3.5% fiscal deficit or whether growth requirements need push the government to renege on that and go to perhaps a higher fiscal deficit. Well, Dr. Mohan, to come back to you once again. Sonal left off the argument by saying that state governments are also going to produce a higher fiscal deficit in FY17 because they have to fund the power reforms. A month ago and even a few weeks ago, the state governments were unable to sell their state development loans even without the excess. The spread with Government of India paper, which normally was 25 basis, went up to 40 basis. So state governments are borrowing at a heavy price. Given that, do you think that there is appetite for more government bonds, even if there is a very good justification? Let me go with a 3.8% fiscal deficit. That will mean a government borrowing program which will be at least 25% more than what it is estimated for FY16. Will it not come at yields of over 8%? Then will it be worth it?
I would then, however, again say that given the circumstances, with the global economy being in the state that it's in, the IMF has been revising downwards its predictions, its forecasts for global economic growth consistently, if I remember correctly, I think for the last 3 years. Each and every forecast has been revised downwards. Second, in terms of being able to keep the commitments, etc., remember that the huge monetary policy stimulus through unconventional monetary policies in the United States, in Europe, in Japan, their expectations in terms of recovery of the global economy have been belied. So given these conditions where the kind of forecasts the IMF has been making for the global economy, the kind of expectations the central banks of the Federal Reserve, the ECB, the Bank of Japan have been making, which have not fructified, that it's not surprising that some of our forecasts also don't get fructified. So in that sense, we are in a special situation in the global economy. And so if there is something that the government can do in a credible fashion, both combining the resource-raising side, both in terms of off-budget, also as said, even on-budget, that if you segregate the funds raised from infrastructure bonds, even on-budget, not off-budget, but credibly in a separate account, which only goes to infrastructure investment, it does seem to me that if you do that communication properly, if you do the implementation properly, then it does seem to me that the market will not react as badly as it might if you just raise the fiscal deficit without giving that kind of information and that kind of implementation commitments.
Well, actually, Dr. Mohan, let me persist with this for a bit more. Like I told you, the appetite was not there this year. The only way the Reserve Bank, this time it was a 5.1 lakh crore, 5.15 lakh crore net borrowing, and in FY17 it might well be northwards of 5.4 lakh crore if the fiscal deficit came in at probably 3.8, 3.9% of the GDP. Now, the point is, the only way this can keep the yields below 8% is if RBI bought more bonds, did more open market operations, expanded its balance sheet. That is, for me, it looks like the only way out. Is that what you want?
No, what I would say in the context of the expansion of the Reserve Bank balance sheet, that the expansion of the Reserve Bank balance sheet should be proportionate to the expansion of the expected growth in the economy as a whole, while keeping.
Sir, that's what it is, sir, this year. Sir, that is what it is this year.
I'm sorry.
This year, reserve money growth is 11.3%. Nominal GDP actually in the first 9 months is not even in double digits. So actually, even the current year's OMO and reserve money creation is over 11%, 11.3%. Next year, if you have to account for a higher bond buying, then we will be way above nominal GDP. Are you okay with that?
No. As I'm saying, see, these are not one-to-one relationships, and they vary. So, only thing I would say is that the Reserve Bank does need to make sure that the expansion of its balance sheet is consistent with the kind of monetary program that it would like to have. It should not do excessive expansion. I'm very clear on that it should not do excessive expansion of the balance sheet.
Yep.
But nonetheless, these are not one-to-one relationships. Those things that you have to make some certain judgments on what is feasible, what is credible, and what is prudent. So I certainly would not say that, look, the Reserve Bank should go all out to expand the balance sheet so that the government's borrowing program gets done on a reasonable basis. The government does need to get market signals in terms of the cost of any kind of higher borrowing. So I would not want to do that. But nonetheless, I do think that you need to maintain a certain desirable growth of the Reserve Bank balance sheet that is consistent with its monetary program.
Fair enough. Well, Jahangir, this investment capex by the government to ensure GDP because nobody else is investing. What is the total capital expenditure? On non-plan side, it is about 1 trillion rupees, actually less than that, estimated FY16. And plan expenditure is another 1.3 lakh crore. 2.3 lakh crore is about 2% of the GDP. Does it really amount to a huge push to the GDP growth? 2 lakh crore rupees?
No, it doesn't, and I would also disagree that this is a time when we should be pushing for infrastructure investment. I know infrastructure investment is motherhood and apple pie, but almost every corporate will tell you that the reason why they're not expanding is there is no visibility of sustainable demand. And that's where corporate investment is stuck. It's not because the government is not crowding in corporate investment by doing a little bit more of public investment. We tried that this year. What happened? The corporates just shrugged it off and they walked away. We need to figure out what is an alternative sustainable source of demand. And the alternative source of demand, if it has to be consumption, domestic consumption, then the structure of public finance needs to change. You can't go on spending on infrastructure. You need to start spending on things where the private sector has a huge amount of spending out of pocket, which is health and education. Where the largest amount of precautionary savings is done by Indian household is in children's education and in their own retirement health. That's the place where the investment has to take place. That's where the expenditure has to grow, not building some, a few more ports. I mean, it's not going to do very much.
I take your point. Okay, right. Jahangir, we are running out of time, so quickly, Sonal, the other point that both you and Dr. Mohan alluded to is the off-balance sheet raising of money which can help. But wouldn't that also come at a much higher interest rate? If government bonds within the fiscal deficit limit are themselves being raised at 7.95% today, off-balance sheet money will come more expensive. Is this really an idea that will work?
I think other than, raising more bonds, what I also had in mind was, financing also by public sector companies. You mentioned, Latha, that the aggregate capex by the central government is only about 1.7% of GDP. You're right, it's quite low. But if you add up the capex by state governments and public sector companies, aggregate is actually closer to 5.5% to 6% of GDP. So I think with center and state a bit constrained, there will be, in my view, a greater reliance on public sector companies to do capex. Second is, leveraging on the National Infrastructure Investment Fund, which was, visioned last year. So if the fund can get more money from the sovereign wealth funds, or can, government puts in some equity and then the fund raises some debt and can finance some of the infrastructure projects that might not necessarily have a negative impact on the bond market. And third, also, greater reliance on some of the, offshore funding, sources of funding. For instance, Japan, for some of our projects, has lent long-term money at very low interest rates. So if we can tie up for long-term funding at lower interest rates from some foreign sources, then we might not see the crowding out that we are, fearing at this stage.
All right. Well, actually out of time, but not out of ideas, definitely. This is a star panel and it has come with a lot of disagreement, but with a lot of agreement as well. Dr. Mohan, Sonal, Jahangir, thank you very much for joining me. Well, the key takeaways, there is still a lot of debate on whether the fiscal deficit should be kept at 3.5%. people in favor of keeping the deficit at 3.5%. 1 no. I would add my weight to the people who say that it should be at 3.5%. So at the moment, the majority is with fiscal prudence. But within that, the investment avenues itself, there is a lot of disagreement. Dr. Mohan preferring more investment in infrastructure and roads and rails and ports, and Jahangir preferring that the investment come in services. So those are two very important ideas from this panel. And more importantly, raising the pie itself through new means. Dr. Mohan referred to newer way of taxing. We are still a very, very undertaxed country if you looked at tax to GDP and off-balance sheet money that can be raised, especially as Sonal pointed out, through the NIIF, tying up long-term funds with multilateral bodies. Divestment and privatization is an area that we have not yet thought about, though at this point in time, resource companies which are with the public sector perhaps will not fit in much. A fourth point that I could not raise, bank recapitalization. Probably if banks are recapitalized, the government might, with a smaller amount of money, get a larger growth multiplier than if it tried to spend the money itself. A larger role for the banks. That will be the idea that we will discuss in our next edition of Ideas for India. Thank you very much for watching this one.